from the current framework, which stands at just over 1.2 trillion euros, or approximately 1.1% of gross national income, covering the years 2021 to 2027. The substantial increase in the proposed budget raises questions about the European Union's capacity to finance such an ambitious plan, especially amidst deepening political divides among member states and already stretched resources. The debate centers on whether this enlarged budget can effectively deliver on the European Union's numerous promises and objectives. This financial framework is crucial for funding various European Union policies and initiatives, including those related to climate action, digital transformation, and social cohesion. The discussions surrounding the budget will likely involve intense negotiations among member states, each with their own fiscal priorities and economic challenges. The outcome of these deliberations will significantly shape the European Union's economic trajectory and its ability to address future challenges and opportunities.
European Union prepares retaliatory tariffs amidst escalating trade tensions with the United States. The European Union is readying a package of tariffs on United States goods as a response to new tariff threats from President Donald Trump. The European Union is actively preparing a package of tariffs targeting 72 billion euros worth of goods from the United States. This measure comes as a direct response to President Donald Trump's recent declaration of a 30% reciprocal tariff on European imports, set to commence on August 1st. The European Commission, responsible for overseeing trade policy within the European Union, has reportedly compiled a comprehensive list of duties that would apply to various United States imports, ranging from automobiles to bourbon. This development follows months of ongoing trade negotiations between the European Union and the United States, which have seen fluctuating tariff threats from the United States president. Economists at Barclays estimate that a 35% United States tariff on European Union goods, combined with a 10% retaliation from Brussels, could reduce the Eurozone's economic output by 0.7 percentage points, bringing annual growth down to a mere 0.4%. Such a scenario would significantly hinder the Eurozone's already modest economic recovery, which has struggled since the COVID-19 pandemic and the surge in energy prices following the conflict in Ukraine. European Union trade officials emphasize the necessity of protecting the European Union economy and implementing these rebalancing measures if a negotiated solution is not found before the August 1st deadline. The latest tariff list, seen by various media outlets, includes significant duties on United States aircraft and parts, alongside other industrial goods.
EU spending spree, what it means for the economy. Geopolitical realities and financial capability are prompting a significant public spending increase in the European Union. The European Union is embarking on a substantial public spending initiative driven by current geopolitical circumstances and available financial capacity. This ambitious plan, highlighted by a major announcement at a recent North Atlantic Treaty Organization meeting, involves allocating considerable funds towards defense and infrastructure projects over the next decade. Specifically, an injection of 500 billion euros in special funds is anticipated to stimulate the economy during this period. Germany, having experienced past underinvestment in infrastructure, is expected to see the largest increase in such spending. Other major European Union economies, including France and the Netherlands, will also experience decent growth in infrastructure investment, while countries like Italy and Spain will remain heavily reliant on European Union funding. The risk of inflation stemming from this increased expenditure is mitigated by the existing spare capacity within many German construction companies and other European industries. Furthermore, governments have previously reduced their debt levels, providing them with the necessary fiscal space to borrow and invest more in public projects without jeopardizing their financial stability. The shift towards a more growth-supportive fiscal policy is expected to lessen the reliance on monetary policy for economic support, thereby reducing the need for further interest rate cuts. This evolving policy mix is also seen as beneficial for the euro, potentially improving interest rate differentials and attracting increased foreign investment flows into the European Union, thus providing additional positive momentum for the currency. European Union allocates billions for sustainable transport projects. Significant investment aims to enhance connectivity and green mobility across the continent. The European Commission has announced a substantial investment of nearly 2.8 billion euros into 94 transport projects. These projects are designed to bolster sustainable and interconnected mobility throughout Europe. This funding comes from the Connecting Europe Facility, which is the European Union's primary instrument for strategic infrastructure investments. The initiative focuses on modernizing railways, inland waterways, and maritime routes within the Trans-European Transport Network. By upgrading these vital arteries, the projects are expected to improve connections between European regions and cities, spanning from north to south and east to west. Furthermore, these investments are anticipated to make the European
Euro area bank interest rates show mixed trends in May. New data from the European Central Bank reveals shifts in borrowing and deposit costs for businesses and households. The European Central Bank released its statistics for Euro area bank interest rates in May 2025. The composite indicator for the cost of new loans to corporations saw a decrease of 15 basis points, settling at 3.65%. Conversely, the indicator for new loans extended to households for purchasing homes remained largely stable at 3.30%. For new deposits with an agreed maturity from corporations, the composite interest rate declined by 10 basis points to 2.06%. However, the interest rate for overnight deposits from corporations showed minimal change, staying at 0.58%. Households also experienced a reduction in the composite interest rate for new deposits with an agreed maturity, which fell by 11 basis points to 1.87%. The rate for overnight deposits from households, similar to corporations, remained unchanged at 0.29%. Specifically, the interest rate on housing loans with a long initial rate fixation period exceeding 10 years slightly increased by 8 basis points to 3.12%. This movement was influenced by both the interest rate itself and the weighting effects within the calculation. 1 in 3 Asian firms seek more trade with South Asia. Companies in Asia are increasingly looking to expand their trade relationships within the South Asian region and with Europe. A significant trend is emerging among Asian companies, with more than one-third expressing a desire to increase their trade activities with South Asia. This indicates a strategic reorientation of business interest within the continent. Concurrently, a similar proportion of these firms are also aiming to enhance their trade ties with European markets. This diversification of trade partners suggests a response to evolving global economic dynamics and potential shifts in traditional trade routes. Conversely, over 1/4 of Asian companies are planning to reduce their trade engagement with North America. This could be influenced by various factors, including ongoing trade tensions, changes in consumer demand, or a strategic pivot towards closer regional integration. The focus on South Asia highlights the growing economic potential and market opportunities within that subregion. Businesses are likely seeking new avenues for growth and resilience in an increasingly complex international trade environment. This shift could lead to stronger intra-Asian trade networks and a more diversified global supply chain.
East Asia crashing, dynamism undone by demographics. Plummeting birth rates and aging populations are shifting the global growth center westward. East Asia, once a powerhouse of global economic growth, is now facing significant challenges due to demographic shifts. Japan, which previously led the region's economic boom, has become an example of the stagnation affecting many countries, including South Korea, Taiwan, and potentially Shikagona. The primary drivers of this shift are rapidly declining birth rates and an aging population. As the productive segment of the population, those aged 15 to 64, shrinks as a percentage of the total, economic activity naturally slows down and growth is blunted. This trend is evident in Japan's growth rate, which has hovered between 0 and 1%, and South Korea's, which has been between 1 and 2%. Taiwan's growth has ranged from 1 to 4%. The Chicagonese government reported a 5% growth rate for 2024, but some analysts question the credibility of this figure given underlying economic conditions. Domestic demand in Chicago has remained sluggish due to a prolonged real estate crisis, and deflationary pressures have been increasing over the past 2 years. Furthermore, Shikagona is experiencing an outflow of foreign capital, influenced by various factors including tighter regulations stemming from friction with the United States.
Chicago's economy grows 5.3% in first half of 2025 in show of resilience. Official data defies gloomy forecasts despite ongoing trade tensions with the United States. Chicago's economy expanded by 5.3% in the first half of 2025, according to official data released on July 15th. This performance largely aligns with the government's full-year growth target of approximately 5%. Despite persistent